Yeah, so we are looking at that question for April 2023, question number 3. So April question number 3. April 2023, question number 3. Question number 3. The question we are looking at. So the question reads as follows. The following to your balance was prepared by Salama Limited as at 31st of December 2022. So you are given some capital items there. So we have 8% in preference shares, ordinary share capital. We have 6% debentures, evaluation reserve, retained earnings at the start of the period. Then you have 11. Then you have inventory at the start of the period, purchases, distribution cost, admin expenses, interest paid on debentures, interim dividends paid on ordinary and preference, investment income, leasehold building, plant and equipment at costs, furniture and fittings at cost, investments, accumulated equity, leasehold paid on buildings, plant and equipment, furniture and fittings, accounts receivable, the bank overdrafts, accounts payable, deferred tax of 5,200 on the credit side, which is a deferred tax liability at the start of the period. Then we have a suspense account, which has an amount of 26 million. Then you have some additional information you are told. The inventory as of 31st of December 2022 was valued at 16 million. However, there were some goods which were considered obsolete with a net realizable value of 400 and a cost of 150 with a net replacement value of 350,000. The 6% debentures were issued on 1st of July 2022. Interest on debentures is paid semi-annually. The policy of the company in relation to the depreciation is as follows. For leasehold buildings, they actually depreciate them at 4% straight line basis. Plant and equipment, 20%. Furniture and fittings at 4% on reduced balance basis. The plant and equipment had a residual value of 5 million. Depreciation is classified as a cost of sales expense, except for depreciation on furniture and fittings, which is to be classified as an admin expense. The taxable timing differences for the period were 24 million, with the deductible timing differences having 10.5 million during the year. The corporation tax is 21.4 million to be provided for the year. Then the suspense account, which you are given there as 26 million, had this kind of proceeds. There was a sale of our plants at 16 million, whose cost was 20 million, and an accumulated dip of 2.5 million. So whenever you see this, they just want you to calculate either profits or loss on disposal of that land. Shillings 10 million is being a bonus issue of shares. The directors proposed to pay a final dividend of 1.5 per share on the outstanding shares at the year end. The tax rate was 30%. Then you are called upon to prepare a statement of profit and loss. Then also you prepare a statement of changes in equity. Then you prepare a statement of financial position as of 31st of December 2022. So very important you understand how you prepare the published financial statements as per the required market given there. So there's a special way we actually categorize the expenses in published financial statements. So in the income statement, you don't just end up having to jumble up the expenses as expenses or maybe incomes. So, but there's a special way you will likely end up having to present them. So all the expenses will likely be categorized as cost of sales. You are preparing published financial statement. The expenses will likely be under cost of sales, will likely be under admin expenses, will likely be under distribution costs, selling and distribution costs. Distribution cost, then you can be able to have the 5 costs. So all the expenses will likely be categorized into this form when you are preparing the published financial statements. So don't make the mistake of having to just list the expenses anyhow in depreciation, left, right, and center. Will be advised by the examiner. Some of the depreciation expenses you likely categorize them under admin or distribution, or you can actually put them under cost of sales. If it is any form of interest, you likely be able to put it under the finance cost. The finance cost. Then at the same time, when you are preparing the statements, this one is for the income statements. When you are preparing the statement of financial position, for all the items involving assets, you won't just end up having to list their land, buildings, like that, we have actually gotten used to. But ideally, under public financial statements, you categorize all these assets under what we call property, plants, and equipment. So it means for these items, you'll have to do a separate working or calculation. Then you just get what one figure, which you'll be able to place in the final accounts, which the examiner would have actually called upon you to do what? To prepare. So never make the mistake of listing the items under property, plant, and equipment as separate items in the statement of financial position. You'll get a zero there. You'll actually be able to get a zero there, but you must actually end up having to prepare a PPE schedule or do a working for property, plant, and equipment, combine all the assets under property, plant, and equipment, you get one figure, is the one you'll be able to utilize in having to prepare the statement of financial position. That is actually very important to take note of when you are preparing what we refer to as what? The published financial statements. So let's have a look at this calculation here and see how we could have actually been able to do these calculations and eventually prepare those final accounts. We can do some few workings here before we eventually prepare the final accounts, which will actually be called upon to prepare by the examiner. So the workings. So let's look at some workings here. Look at the workings. Some workings. We are presenting our workings in shillings of thousands. We are presenting our workings in shillings of thousands. We are presenting our workings in shillings of thousands. So that's note number one. Look at note number one. So this is what you're having to be told. The inventory as of 31st of December, this is the closing inventory. So working one is actually on what? Closing inventory. The first working is actually on what? Closing inventory is actually on closing inventory. This is what you have to be told. The inventory at the end of the year was valued at 16 million. However, there were some goods which were considered obsolete with an NRV. So there are some goods there. So some of these goods, there are goods where we have the net realizable value having to be the net realizable NRV having to be 400,000. Remember, our figures are already in thousands, so it's just 400. And the cost of these items, is actually 450. The cost of these items is actually 450. So these items, net realizable value is 400, but the cost of these items is 450. With a replacement, let's assume if they end up having to replace them, they will replace them at a value of 350. So according to IAS number 2, according to IAS number 2 on inventory, so we normally measure inventory at the lower of the two, lower of NRV and the costs. We normally measure inventory at the lower of NRV and the cost. We normally measure inventory considering the lower of what? NRV and the cost. So it means for us to measure these items as what will likely be under the closing inventory, then we have to look at which one is the lower. The lower is actually this one. Is actually 400. And take note, already these items are included in the 16 million. Are already included in the 16 million because you are told inventory at the end of the year was valued at 16 million. But now we have to do what? Look at some of the items already included in the 16 million, which wouldn't end up having to be valued at 450, but they'll actually be valued at what? At their NRV, which is lower than what they cost. And therefore, to get the correct value of the closing inventory, we'll say we'll have 16 million. First of all, we remove the ones that are not properly valued at 450. Then we end up having to add on now the proper value of these items, 400. So that will likely give you a figure of how much? 15,950. So you'll be able to get 15,950. 15,950. So this now will be our value of closing inventory that you'll be able to use to calculate the figure for cost of sales, and also we'll be able to place it in the statement of financial position. So that figure for replacement value, ignore it. So you're not having to look at how these items are having to be replaced, but you are looking at the evaluation of these items according to IAS number 2, where you are supposed to value closing inventory at the lower of cost and the net realizable value. So when we correct these items, which are already included in this 16 million, we first of all have to remove them, which are valued inside here at 450. Then we put the correct value, which is actually 400. You'll get a value of 15,950. So that will likely end up having to be the value of the closing inventory. We'll take the statement of financial position, and also we'll be able to use it to calculate the cost of sales, cost of sales, cost of sales, cost of sales, cost of sales. So let's look at note number 2. The 6% debentures were issued on 1st of July 2022. Interest on debentures is payable semi-annually. So the 6% debentures, you can see a figure of 6% debentures, which is having to be valued at a value of how much? 10 million. So you can have our working number 2. Let's have our working number 2. Interest on debentures. Interest on debentures. Interest on debentures. So take note, these debentures were issued on 1st of July 2022. Our year end is 31st of December 2022. So it means these debentures are for how many months? These debentures are for how many months? It means these debentures are for how many months? Hence, these debentures are for how many months? These debentures are for how many months? Faith. It means these debentures are for how many months? 6 months. Yeah, for 6 months. And therefore, you are computing interest, you are portioned according to what? Time period. So the interest on debentures will likely be 6 out of 12 times the interest, which is actually 6%, times the value, which is actually 10,000, 10,000 or 10 million. What are you having to get? Faith. What are you having to get? Faith. What are you getting? What are you having to get? What are you having to get? So 6 out of 12 times 6% times 10,000. What are you having to get? Do the calculation and tell us what you are getting. Tell us what you are getting. What are you getting? What are you getting? 300. So you like people to get 300. So 300, right? You end up having to get 300. So this 300 will likely be part of what? The finance costs. It will be part of the finance costs. Finance costs. But there's another interest. I don't know whether you can be able to identify this. Can you identify any other form of interest? Can you identify any other form of interest? It's another interest. Are you able to identify any other form of interest that we have in the question? It is another interest. Joy, let me not just think for you everything. So also try to think by yourself and tell us if you are seeing any other form of interest. So which one is it? If you are seeing it, which one is it? If you are seeing it, which other form of interest are we having? You look at the question and see whether we have any other form of interest and tell us whether you can be able to see any. Interest on what? Interest on debentures, that is what you calculated. There's another interest. That's what you calculated. There's another interest in the question. Don't even look at the additional information. There's another interest. You have to be able to see it. Maybe you can't see. Maybe you can't see. You should be able to see. We should be able to see interest on the redeemable. Interest on redeemable preference shares. Interest on the redeemable preference shares. So you can be able to see interest on the redeemable preference shares. So because these ones actually existed for the entire year, so you'll be able to take 8% times the amount, which is actually 12,000. Yes, it is 12,000. So how much are you getting as interest on redeemable preference shares? So 8% times 12,000. You can see it is the second item in the tree of balance. This is the second item on the tree of balance, 8%. Redeemable preference shares. 8% redeemable preference shares interest. So it's that interest. So how much are you getting? 960. There are also 960. So you're getting 960. So in total, we'll be able to have there an interest of how much? 1260. We'll have an interest there of 1260, an interest there of 1260. So this now will likely be able to accumulate what the total finance cost. Total finance cost, the total finance cost. So take note that there are two kinds of redeemable preference shares. So we can have, there are two kinds of preference shares. You can be able to have what we call irredeemable preference shares, and we can actually end up having to have what we refer to as redeemable preference shares. So you can have irredeemable preference shares, and you can actually end up having to have what we refer to as what redeemable. Like the only value being given in the question, it is known as what redeemable preference shares. The redeemable preference shares, they do not really exist in the company for the lifetime of the company, and therefore they are normally recognized under the non-current liabilities. They are normally recognized under the non-current liabilities. These ones, the company will redeem them maybe after 2 or 3 years. What it means by that, the company will end up having to buy them back. So they won't be there as a long-term means of capital for the company. It's like just a loan advance to the company. It will be, for example, for a period of 5 or 6 years. The debentures won't actually be there for the lifetime of the company. They'll likely end up having to be paid off eventually once the maturity period has actually been realized. So for the redeemable, we normally recognize them under the non-current liabilities. For the irredeemable, these ones exist for the lifetime of the company, and therefore what ends up having to happen, you'll recognize them under equity items. Equity items. And I hope already we are talking about the statement of financial position. In the statement of financial position for the irredeemable preference shares, you actually recognize them under equity items because is a lifetime capital for the company. Unless the company is liquidated, is when now the principal amount under this amount, this particular preference shares will be settled. But for the redeemable ones, they are just for a short-term period. So you likely recognize them under non-current liabilities. Therefore, that's what you need to be able to know about the irredeemable and irredeemable preference shares. That is actually very important. Take note of that. So we can now proceed and actually look at what the depreciations. The depreciations can now look at the depreciations on those items as you've actually been advised in additional information number 3. So the depreciation, look at the depreciation. So this is what we do. Depreciation. Depreciation. So what are you having to be told? You are told the policy of the company in relation to the depreciation of its assets is as follows. So leasehold building is likely to be depreciated on 4% on straight line basis. So what is the value of leasehold buildings? Leasehold buildings. The value is actually 56,250. So we can start with what? Leasehold buildings. Leasehold buildings. So for the leasehold buildings, already you've actually been advised, it is 4% on straight line basis. What do you mean by 4% on straight line basis? We take 4% times 56,250. What do you get as the value of depreciation? 4% on straight line simply means we take that percentage on costs of the item. On cost of the item, I can see 33, 35, 73.75. Is it correct? 4% of 56,250. 4% of 56,250. You're getting how much? I see 2250. So which is which? So which is which? 33. So 2250 is the dominant term. So when you have the 2250, so this 2250 will classify it as what? We'll classify it as what? We'll classify it as what? As cost of sales. Esther, look at the final statement you've actually been given on that additional information number 3. Esther, look at that additional information you've actually been given in that same note. You are told the depreciation is classified as a cost of sale expense, except for depreciation on furniture and fittings, which is to be classified as an admin expense. So you have to remember, because I already advised you, under published financial statements, the expenses are normally specially categorized. So it means this item of depreciation, you won't categorize it separately in the final income statement. You'll likely put it under what? Cost of sales. You've already been advised by the examiner, Esther. you put it under cost of sales, and then you have to remember it will go to what? The cost of sales. If you go to the cost of sales, go to the cost of sales. Then for plant and equipment, you are told that it is 20% on straight line basis. So for plant and equipment is actually 20% on straight line basis. Still actually straight line basis. But of course, you have to be very keen. You have to be very keen. You have to be very keen as what you are having to be told here. You are told that just down there, you are told plant and equipment had a residual value of 5 million. So that is like the terminal value. Once the lifetime has come to an end, it will have a residual value of 5 million. Then also you are told what? Look at additional information number 6. You are told the suspense account represents 2 components. So you have proceeds from sale of plant of 16 million, whose cost was actually 20 million, and an accumulated depreciation of this item is already 2.5 million. It's already 2.5 million. So it means when you are calculating the depreciation for this year, we won't consider the depreciation for this item, which has already been disposed. And therefore, what you're going to do still exactly on the reducing balance basis. This one is exactly what plant and equipment. So you can go to plant and equipment. Plants and equipment. Plant and equipment, you have to be very keen there. Actually, you have to be very keen there. This examiner wants to confuse you. You have to be very keen there. So what is the value of plant and equipment? Let's see, plant and equipment is actually 55,000. So we'll say 55,000. But you don't have to depreciate the items which are going to be disposed of. Exactly how much? 20,000, which is the cost. Then also, the residual value of these items, when it is actually at the terminal level, will remain 5. The residual value will actually remain 5. The residual value will remain 5. So you have to remove the item which is having to be sold. In additional information number 6, is an item of plant and equipment. Item of plant actually, which they are having to sell. The cost of this item, which is already inside here, is 20. We have to remove it because in this year we are accounting for, we won't account for its depreciation. It is being sold. It's not part and parcel of our assets. Then the residual value that will actually remain at the terminal life of these plant and equipment items will be 5. Then after that, you can actually be able to multiply with 20% because it's actually on straight line basis. What are you getting? 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 What are you having to get now? You're getting, I can see Sharon say 6 million. 6 million seems to be the dominant figure when you are paid. When you are paid is equals to 6 million. This 6 million already actually been advised. You take to cost of sales. You've already been advised. You take to what? Cost of sales. Because you are told all depreciation should actually go to the cost of sales, apart from depreciation on furniture and fittings. That one, you won't take to cost of sales. You take to what? The admin expenses. You take to the admin expenses. And therefore, we've already covered that depreciation for what? Plant and equipment. Let's go to furniture and fittings. Let's go to furniture and fittings. You are told furniture and fittings, we depreciate at 4% on the reducing balance basis. Reducing balance basis, it simply means you have to calculate that depreciation on the net book value. What do you mean by net book value? You have to take the cost of the item less already accumulated depreciation. Then now is when now you put what? The percentage. You have to put what? The percentage of what? Depreciation. Because it is reducing balance basis. The cost of these items of furniture and fittings, from the question, we can be able to see how much. Furniture and fittings, they were actually valued at 35,000. So for furniture and fittings, you have furniture and fittings. So they were valued at 35,000. So we have to minus what had already been accumulated as the depreciation. It is 9,600. Then now we have to now calculate depreciation of this one at the rate of 4% times 4%. So what are you getting? 35,000. We reduce it with already accumulated depreciation, which is in the true balance. Don't start asking us, why are you getting 9,600? It is in the true balance, accumulated depreciation. So what are you getting? Joy. What are you getting? What are you getting? When you do the calculation, what are you getting? What are you getting? I can see Sharon says 1016. Is it correct, Ashley? 1016, wengi wape, wengi wape, wengi wape, 1016 is actually correct. But you have to be very keen here. Already testing in advice. Now this one not go to cost of sales. The examiner is clearly advising you. For this depreciation on furniture and fittings, this one we are going to take towards admin expenses. You shouldn't forget. It will be accumulated under admin what expenses when you are coming up with your final income statement. We shouldn't forget it will go to admin expenses. It will end up having to go to admin expenses. It will end up having to go to admin expenses. We have to remember that one. You have to remember that one. You have to remember that one. You have to remember that one. And you can continue. So you're told the taxable timing differences. Now this is what you refer to as what? Deferred tax. These are matters pertaining to deferred tax. Matters pertaining to deferred tax, which is a concept that never misses in a published financial statement question, which is a concept that actually doesn't end up having to miss in a published financial statement question, which is a concept that never misses. You are told that that is working number 4. You can go to working number 4 very fast. Working number 4 very fast. It says the taxable timing differences were at 24 million, with deductible timing differences having to be valued at 10.5 million during the year. So when you see this, they actually just having to call upon you to calculate the deferred tax liability for the period, which you are supposed to accumulate together with the current tax expense. And overall, you'll be able to get what we refer to as what? The income tax expense. You'll be able to get the income tax expense. You'll be able to get the income tax expense. So this is the deferred tax. Deferred tax liability. So how do you normally get deferred tax? So deferred tax is equals to the tax rate multiplied by the timing differences. Multiplied by the timing differences. You normally take the tax rate, you multiply by the timing differences. So how do you get the timing differences? Who can be able to tell us? How do you get the timing differences? The timing differences, how do you get them? The timing differences. So this one I normally simply will take what? The carrying amount. You can take the carrying amount. The carrying amount of an asset. The carrying amount of an asset, you minus the tax base. The carrying amount of an asset, you minus the tax base. The carrying amount of an asset, you minus what? The tax base. Minus the tax base. So already they have actually given you what we refer to as what? The deductible timing differences. They have given you the deductible timing differences, and the taxable timing differences, and the taxable timing differences. So this one simply means they are the negatives. When you do this carrying amount minus tax base, they are the negatives you are getting. And these taxable timing differences are the positives you are getting. The positives you are getting. And then we have to set them off, or you have to add them. You have to set them off to be able to get the timing differences, which when you multiply by the tax rate, you get the deferred tax liability by the end of the period. You get the deferred tax liability by the end of the period. So when you take the carrying amounts and the tax base of the assets in this company, you will get the negatives, which will be given the total value having to be how much? It is 10.5 million. So this one comes to 10.5 million. And when you take the carrying amounts and tax base of the assets also of this company, there are those you're having to realize they are giving you positives of an amount of 24 million. 24 million. 24 million. So now you actually add the two, or you basically set off the two, you'll be able to get the timing differences, which eventually you multiply by the tax rate, you'll be able to get the deferred tax liability at the end of the period. And then it means our DTL at the end is equals to the tax rate you've actually been given in note number 8. It is 30%. In note number 8, then you multiply by, you need to get those timing differences. You simply take 24 million minus 10,500. So what are you getting as the deferred tax liability at the end of the period? Do the calculation. You should be able to get it. do the calculation, you should be able to get it. The deferred tax liability at the end of the period. The deferred tax liability at the end of the period. The deferred tax liability at the end of the period. I can see actually says 40/50. So 40/50 is correct. 40/50 is actually correct. So take note, this is the deferred tax liability at the end of the period that you just calculated. That's how you normally calculate it. So you will actually be able to get the timing differences multiplied by the tax rate. You will get the deferred tax liability by the end of the period. Already they have given you these figures. So you just do the setup. And of course, now you can be able to calculate 30% on that. But now remember, you've also been given the deferred tax liability at the start of the period. So the deferred tax liability at the start of the period is how much? Who can be able to identify it? The deferred tax liability at the start. Remember, this one is at the end. The deferred tax liability at the end is actually an amount of 40/50. But at the start is how much? At the start is how much? Identify. Try to identify it, my friend. You'll actually be alone in the exam. I won't be there. Try your best in identifying it. It's actually an amount of 5,200, which is actually in the TO balance. Always you'll be given the TO balance on the credit side. When you see the deferred tax liability in the TO balance on the credit side, that simply means in the deferred tax liability at the start of the period. What you've calculated using the additional information is the deferred tax liability at the end. What you've been given in the TO balance, it is on the credit side, it will likely always be the deferred tax liability at the start of the period. What now you'll be able to use to get in the additional information is the deferred tax liability at the end. And then you have to identify two things. Either it is actually an increase or what? An increase. And if you can be able to look here, Esther, you can see with your eyes from 5,200 at the start as a deferred tax liability, we are coming down to 40/50. There was what? A decrease. There was what? A decrease. There was a decrease. And therefore, is it going to increase? Is it going to increase the income tax expense or is it going to add? Okay. Is it going to increase or reduce the income tax expense? Who can be able to tell us? Is it going to increase the income tax expense or is it going to reduce the income tax expense? Okay. If there's a decrease, is it going to increase the income tax expense or is it going to reduce the income tax expense? Also try to think. Let's assume we are in that exam alone. It's going to reduce, likely reduce. It's going to reduce. Likely going to reduce. Very correct. Very correct. It's like an income that has actually been realized here. It's like an income that has actually been realized here. Of an amount of what? 1150. 5,200 minus this 40/50, you get what? 1150. And then it will likely decrease. And then what will happen? It will reduce the income tax expense. It will reduce the income tax expense. I get what is happening. No. What is happening? Let's assume we have the deferred tax liability account here. Senior, we have the deferred tax liability account here. So a liability account, at the start of the period, it normally has what? A credit balance. It normally has a credit balance. And therefore, what this logically means, we are opening with a balance here of how much? 5,200. This is what this is meaning. Just speaking very fast and saying decrease or increase. We are opening with 5,200. But when we are coming to an end, for a liability account at the end of the period, the balancing figure is normally this. This is the balance brought down. Brought down. Then at the end, you've done the mathematics hand-free. You've done the mathematics hand-free. For a liability account, at the end of the period, that balancing figure is normally this side. Balance carried down 40, 50. Let's assume you're having to balance off these accounts. Let's assume you're having to do what? Balance off this account. When you balance off this account, you realize your balancing figure is this side, which means it will likely go to the P&L account, an amount of what? 1150. And therefore, you balance it off, you have 5,200, and you have what? 5,200. When it goes to the P&L account, you can see it will go there as an income because it will go on the credit side. And then it will reduce what? The expenses. It will reduce what? The expenses, the income tax expense, because it will go there as an income. It will go there as what? As an income. So in short, what you need, if you compare the deferred tax liability at the start and the end, and you realize there's a decrease, it simply means you likely deduct from the income tax expense. But if you realize there's an increase, you'll add to the income tax expense. Let's assume they opened with 5,200, but when they are closing, the liability has gone up to 7,500. Yani liability ile deni ulifungua nayo ukianza mwaka ilikuwa 52. Ukifunga mwaka hiyo deni imeongezeka. That means you are incurring more in terms of that expense. But if it reduces, it's like an income because you've actually really reduced so much your deferred tax liability expense. And then if there's a decrease, you just need to compare. It's a matter of comparing, and you having to know in your mind. When I compare the deferred tax liability at the start of the period and at the end, I realize there's a decrease. That decrease, I deducted from the overall income tax expense. If I compare and realize there's an increase in the expense, then it will increase the income tax expense. And you may be able to demonstrate through an account. You just saw why it likely end up having to be a decrease because it's like an income. When it goes to the income account or P&L account, it will basically be credited there. When you credit it there, it's like an income. And then it reduces the income tax expense. And then what is going to happen here, you've already finished this one. It's just you to be able to master because I can tell you this concept never misses. In a public financial statement question, it never misses. So overall now we can be able to get the income tax expense. Therefore, our income tax expense will likely be equal to what? Will likely be equal to the current tax. Current tax, which will be given in the next note. That is note number 5. Our current tax is actually 21,400. Then for the deferred tax you normally consider, either increase or decrease. You normally consider either increase or decrease. For the deferred tax, you normally consider increase or decrease. If it is a decrease, you normally deduct, then it means we deduct 11.15. So how much are you getting as the overall income tax expense? If it is an increase, you would have added. If it is a decrease, you deduct. Like that. We normally consider either an increase or a decrease. So what are you getting when you do the deduction? You're getting 22.15. That's it, the same 20,250, and we've already been able to complete that one. Already completed that one. So that's how you could have actually been able to come up with that was the income tax and expense, or the income tax expense. Already you've actually been able to finish up with that one. So already been able to finish up with that one. Already been able to finish up with that one. Yeah, so we can now go to the next note, which is actually about the disposal. The disposal, which is actually about the disposal. It's about the disposal. It's about the disposal of that item. So we can prepare disposal accounts just to capture what was the profit or loss. The profit or loss. So we can prepare disposal accounts. So that is working number 5. Disposal accounts. So for the disposal accounts, you normally debit the costs. You normally debit the cost, but you're able to see there. So if you are not able to see that final end, I should just be able to run here. So we'll likely debit the cost for this item, which you are told it was 20 million. the sales proceeds was actually 16 million. Yeah, 16 million. And the accumulated depreciation was an amount of 2.5 million. 2.5 million is an amount of 2.5 million. 2.5 million. And then it means we likely have a balancing figure this side. So it will be this side because it is less than. So if it is that side, it will likely be a loss. Loss on disposal of an amount of 1,500. So this will likely go to the cost of sales. Consider it under the cost of sales. Likely consider it under the cost of sales. It was a loss. Because it's that side. The balancing figure was this side, it would have been a gain. It would have been a gain. If it was actually this side, it would have been a gain. But if the balancing figure is this side, it is a loss. It's a loss. It means what he got when he sold it is far much less than the value, the real value of this asset. Because ideally, when you do this minus this, you are getting 17.5. So you should sell it at more than 17.5. Otherwise, if you sell it at an amount less, that should be a loss. Realistically, the value of this asset is already at 17.5 because if you do this minus what has already been lost is 17.5. But you are selling it at 16. It means you are getting less than the real value of this asset. The real value is actually at 17.5. So it means you have actually made a loss of 1,500. So which will likely go to the cost of sales. Likely go to the cost of sales. Then you have 10 million being bonus. These will be able to consider it with the statement of changes in equity. Then the directors propose a final dividend of 1.5 per share. This will likely end up having to consider it in the statement of changes in equity. The statement of changes in equity. So we can now proceed and actually look at how we could have actually been able to come up with the final statement for profit and loss. But before that, you have to accumulate what the expenses, at least be able to accumulate the expenses, so that you can be able to know what will likely go to the cost of sales, what will end up having to go to the admin, selling and distribution, and eventually the finance costs. The finance costs. And therefore, briefly, before we come up with the statement of profit or loss, let us prepare a statement of expenses. Let us prepare a statement of expenses to summarize all the expenses which we'll be able to finally present in our income statement. So, statement of expenses. So, under our expenses, we do have cost of sales. Under our expenses, we do have cost of sales. We do have admin expenses, distribution. We have distribution. We have admin expenses. And also we have finance costs. We have finance costs. We also have finance costs. So for the cost of sales, we have to compute it. We have to do the opening inventory. We add on the purchases. We deduct the closing inventory so that we can actually be able to know what was actually the value, what the cost of sales. So for the cost of sales, right here, cost of sales is equals to opening inventory plus the purchases minus the closing inventory. So the opening inventory you've actually been given, it is actually 12,400. 12,400 plus is a figure for purchases, 147,200 minus what you calculated in note number 1. In working number 1 as the closing inventory, there was a value of 15,950. And then what is the figure for the cost of sales? So this one is as per the TO balance. As per the TO balance figures, what is the figure for the closing inventory? For the cost of sales, sorry. What is the figure for the cost of sales? When you do that calculation, 1,200 147,200 minus 15,950. Minus 15,950. You'll be able to get the figure for the cost of sales as per the issue balance, or what you'll be given the issue balance. 143,650. So it comes to 143,650. Then distribution cost will actually be given a value of 22,300 as per the trio balance. Then for admin expenses, 34,440. 34,440. 34,440. Then of course, as per the trio balance for the finance cost, interest paid on debentures will actually be given a value of 300. Partly be given a value of 300, a value of 300. So there are a number of items having to affect these expenses that you have to consider. For example, you have depreciation. So you have depreciation on buildings. You also have depreciation on plant and equipment. Plant and equipment, which you calculate the values. You calculate their values. For example, on plant and equipment, we have a value of 6,000, which you've been advised to go to the cost of sales. On buildings, we want you to get a value of 2250. 2250. You've been advised this on the back, you also go to what? The cost of sales. But now we have depreciation on furniture and fittings. This one is not having to go to the cost of sales. You've been advised it goes to the admin. It goes to the admin. It goes to the admin, and the value was actually 1060. The value was actually 1060. The value was actually 1060. So like you go to come here and admin. 1016, sorry. It was actually 1016. The value was 1016. The value was 1016. Then also, you've actually been able to do the computation. You've actually been able to do the computation for what? The loss on disposal. Loss on disposal. Loss on disposal. The loss on disposal you've actually calculated is coming to an amount of 1,500, which you said it will go to the cost of sales. 1,500 will go to the cost of sales. Then we have interest. We have the interest on the redeemable preference shares. Interest on redeemable preference shares. Interest. Redeemable preference shares. So this one you actually got an amount of 960. 960. 960. Already this 300 is what we calculated and is already next to your balance. So you just be able to pick the interest on what? The redeemable preference shares. Then we can now be able to add. Can easily be able to add. So this one actually comes to 1260. 1260. This one remains the same, 22. 300. What about this one? Comes to 35, 456. 35, 156. What about for cost of sales? What about for cost of sales? You can add 143,650, 2250, 6 million plus 1,500. Plus 1,500. What are you getting for the cost of sales? I can see Joy says 153,400. 153,400. So that will be our statement of expense. What it means, we just pick this. Then we can be able to comfortably prepare our statement of profit for those, because we already have those final figures. Already have those final figures. Just be able to plug them in our statement of profit for those, and we should be able to have our final accounts. Be able to have our final accounts. So we are through. So because now I want us to quickly present first of all the income statements. Let's present very quickly the income statements. So it will be Salama Limited. Statement of profits or loss. For the year ended. For the year ended 31st of December 2022. 31st of December 2022. So we are presenting our figures in shillings of thousands. Shillings of thousands. So we'll start with the revenue. Revenue that you've already been told. We'll start with the revenue. Revenue will be given a figure of 1,200. 416. We've calculated the cost of sales. We calculate the cost of sales from our statement. We've already been able to calculate it. It has come to 153,400. It has come to 153,400. So you need to deduct. So when you do the deducting, you'll actually be able to get the gross profits. This one is 0, 60, 0, 0, 3, 1. It comes to 130,060. 130,060. You have to consider whether there is actually any other form of income. And there is an investment income. There's an investment income. Which you can be able to add here is an amount of 1,500. An amount of 1,500. We have an investment income of an amount of 1,500. And now we can be able to consider the expenses which we calculated. Under the expenses, we do have distribution costs. We do have distribution costs. This one didn't actually end up having to change. It remained the same, 22,300. This one you deduct. 22,300, so you actually deduct. It actually didn't change. But you do have the admin expenses. So you've actually calculated, it has come to 35,456. So that also we have the finance costs. It's coming to 1260. It's coming to 1260. So once you all have all these, you'll be able to get the profit before tax. So how much are you getting as the profit before tax? How much are you getting as the profit before tax? Do the calculation. $72,544. You can see $72,544. $72,544. $72,544. $72,544. Then you can now have the income tax expense, which you calculated then. You calculated it was coming to 20,250. Remember that figure we calculated? 20,250 we deduct. 20,250 we deduct. You'll be able to get the profit after tax, which is the final figure. The profit after tax, which is the final figure. So you have to put the income tax expense, which you calculated. Remember it? Now, okay, 2250. and we're going to get the profits after tax, which comes to 52,294. That's 52,294. 52,294. So that is our final figure of the profits for the year. 52,294 the profits. This is the profits after tax. The profits after tax. The profits after tax. So we can have a small break, then when we come back, we can actually be able to now look at the statement of changes in equity, and then now also the statement of financial position. Yes, we can proceed. So confirm whether we can now continue. Are you ready? We continue. Are you ready? We continue. Yeah, so we can proceed. We can now look at the statement of changes in equity. So Salama Limited. So Salama Limited. Statement of changes in equity. It is for the year ended 31st of December 2022. So the year ended 31st of December 2022. So you have to look at the equity items you've actually been given the question. And you look at the equity items you've actually been given the question, we can be able to see ordinary share capital, you can see revaluation reserves, you can see ordinary share capital. We have revaluation reserve. And also we have what else we have? Retained earnings. Remember, for the redeemable preference shares, I told you, you don't actually report it under the equity items. It will be a long-term liability because these ones are redeemable. But if they are if they are irredeemable, these ones now are the ones you report under what equity items that have appeared here. But this one is redeemable. Actually, this one is redeemable. This one you report it under non-current liabilities. So you don't actually report it under the equity items. Maybe you don't actually get that part to appear here. So we are presenting our figures in shillings of thousands. We are presenting our figures in shillings of thousands. So like that, our figures in shillings of thousands, like that. So what is going to happen? We likely first of all we normally start with the balance brought down. Balance brought down is what you've actually been moving with your balance. For the ordinary share capital, you can see it is 20,000. For the revaluation reserve, you can see it's 3,400. And for the retained earnings, you can see we open with 14,160. So under the ordinary share capital, you have to confirm whether there were actually any shares issued. And if you look at additional information number 6, there were some bonus shares that were issued of a value of 10,000. A value of 10,000. Then also during the year, the company made some profits. The company made some profits for the year, which is what you've actually gotten in the income statement as the final figure, which is actually a figure of 52,294. That is the profit for the year. If you go to the retained earnings, 294. Then there was actually what the dividends, proposed dividends. Those the proposed dividends which they are supposed to pay as the final dividend. Although there is already some dividends which they have already paid in the tier balance of an amount of 2 million on ordinary share capital. It's already that which they have already settled of 2 million ordinary the ordinary share capital or the ordinary shares that they have actually issued for an amount of 2 million. But now we are told that they need to pay 1.5. Look at additional information number 7. The directors propose to pay a final dividend of 1.5 per share on the outstanding shares at the year end. So proposed dividends, we can be able to calculate it. So proposed dividends, dividends is actually 1.5 shillings per share times the total number of outstanding shares. This one you can easily also calculate the ratio. You simply just take 20,000, which is the value of the ordinary share capital, divided by the par value of each and every share, 10. And then it means the proposed dividends was how much in total? The proposed dividends was how much in total this time? So 1.5 per share. But the outstanding number of shares you can easily get there. The value of ordinary share capital is 20 million. Each and every share is going for 10. That will be able to give you the total number of shares. It is that what is simple mathematics. So what are you getting here? As the proposed dividends. You are getting the thousands or 3 million. 3 million. So you now come and actually put that dividends. We deduct it because it's normally paid out of retained earnings. Normally paid out of the retained earnings. And then with this, there's no any other entry. We have already cleared our entries here under the statement of changes in equity. In any case, there was an asset because actually valued that would have put here under the preparation reserve, but it is not there. Or if there was not even opening balance and there was an asset because it was valued that would have created a revaluation reserve to appear amongst of the equity items. But we haven't actually been told about an asset having to be revalued. And therefore, the items for the revaluation reserve will remain the same. And we can easily now get the totals. This one is 30,000. This one is 3,400. And this one is how much? Do the calculation for that one. 14,160 plus 52,294 minus 3 million. How much are you getting? What of it dividend paid? So it was already paid. It is inside this one. It's inside this one. But we use it later on. So we use it later on in the statement of financial position. We use it later on also in the sense, so it is already inside here. So how much are you getting in 63? 454. So 63, 454. So where did you able to get that? That dividends. So finally, at the end of the day, they're supposed to pay 3, but already in the interim, around June, they have already paid 2,000 out of this. So what they are yet to pay is their accrued dividend. Here's a liability. There are thousands accrued dividend. They are going to the next year when they haven't settled it. Accrued dividend will now be a current liability. It should be 1,000 because they have already paid 2,000 as the interim. They already paid 2,000 as the interim. That's what will happen there. That is what is going to happen there. So this is already what this because that is what you are supposed to have prepared. It was 4 marks. So it means for each and every entry you are getting a mark. So 1, 2, 3, 4, 5, 6. So there are 6 entries. So for every 4 correct entries, you get a mark. For every 4 correct entries, you are getting a mark. That's how we ended up having to mark that one. That's 6 key entries. So 1, 2, 3, 4, 5, 6. And so you can easily get your 4 marks. Once you just put this opening balances, that is already your mark. Now you need to look at these other village fingers, get either of them that have already been able to score another mark. So it was easy to be able to collect 4 marks again. That's why we're saying in financial reporting, it's a matter of you mastering getting the most correct entries, maximize on getting the most correct entries. So don't get to this question of published, then you start sweating. Say I would even draw that thing as that about the opening balances. You would have just missed 3 marks, imagine. You would have just missed 3 marks. Now that you've seen dust in your P&L account, you are going to prepare in this one. Imagine you would have missed 3 marks just like that. You have just drawn it and put the opening balances. Then you have your 3 marks. You are lucky enough to discover this one, you put it there. You already have your 4 marks. So they likely end up having to mark the entries you are having to put them. They don't look at the final figures here. So there's no mark for these figures. Where you put marks is in the entries. It is in the entries where they actually put what the marks. That's where you put the marks. So we can now look at the statement of financial position. How you could have actually been able to present the statement of financial position. How you could have actually been able to present the statement of financial position. So we shall say Salama Limited. So we are presenting our figures in shillings of thousands. So we shall start with the non-current assets. Non-current assets. The most obvious non-current assets that we have is property, plant, and equipment. We haven't calculated it. You can leave a blank there. You need to combine all the assets and give one figure so you'll be able to create just finally. So once you have this, you need to look at whether we have any other assets apart from property, plant, and equipment. We do have what investments of 34,500. 34,500. It has zero adjustment. So that's the rate amount up there. Always look at the debit side. If there's any other assets, you have another assets like an intangible assets, so you need to be able to put it. Since there's none, so it means you'll actually go to the current assets. So under the current assets, already we've actually calculated the closing inventory. The closing inventory was coming to a value of 15,950. It was coming to a value of 15,950. Then what else do we have? Receivables. Receivables, zero adjustment. That's another free mark extra. Receivables has zero adjustment. It's another free mark that you can't afford to miss out to think. What is the value of receivables that you've actually been given? Accounts receivables, 35,700. It has zero adjustment. Always look at the debit side, whether they have given you any other asset that may be cash or bank. Since it's not there, so we end our story there. Our story about the assets is ending there. Our story about assets, since it is ending there. Our story about assets, it is ending there. Our story about assets, since it is ending there. So we go to the other side, which is actually equity and liabilities. Equity and liabilities. We are still presenting our figures in shillings of thousands. Go to the other side, which is actually equity and liabilities. Equity and liabilities. Already, for the equity items, we prepared the statement of changes in equity, which has given us the ordinary share capital already. It has given us the evaluation reserve already. And it has given us the retained earnings figure already. So you just pick them the way they are in the statement of changes in equity. You just pick them the way they are in the statement of changes in equity. So for the ordinary share capital, it is 30,000 for 30 million. This one is 3,400. And for the retained earnings, those 50 watts, 64,463. 63,454. 63,454. So there's no any other equity item. So you go to the non-current liabilities. For the non-current liabilities, we do have the 6% debentures. We do have the 6% debentures, which is actually a value of 12 million or 10 million. 10 million. We have the redeemable preference shares. Which is a value of 12 million. A value of 12 million. We have any other non-current liabilities? Let's have a look. Deferred tax. We have the deferred tax that you just calculated. Deferred tax that you calculated, the deferred tax liability at the end, the one you calculated, it was coming to 40. That one also comes under what non-current liabilities. Always the deferred tax has to be there. The one at the end, the one you calculated, 40, 50. Always look at the credit side of the share balance whether there's any other liability. If it is not there, it means you're having to go to the current liabilities. We are going to the current liabilities. So under the current liabilities, you have a bank overdraft. You can see a bank overdraft. Look at the share balance. There's a bank overdraft. A bank overdraft of 1680. Then also we have accounts payable. Accounts payable. 17,770. Zero adjustment. The free mark. 17,770. Zero adjustment. It is a free mark. It is a free mark. Who can be able to tell us what else are we going to place here? Actually, what else are we going to place there on the current liabilities apart from the two? What else are we going to place there under the current liabilities? What else are we going to place there under the current liabilities? Apart from the two. What else are we going to place there apart from the bank overdraft and the accounts payables? The proposed dividends, so due, so accrued dividends, which will be 3,000 minus 2,000, which have already been paid. 2,000 has already been paid because you can see in the share balance, interim dividend paid on ordinary share capital is already 2 million, has already been settled. So it means the accrued, which will move to the next year, we haven't settled as a liability. It will be 1 million. 1 million, what else? What else? What else? What else? What else? Yes, I can see preference. So also, if you look at the preference, for the preference, you can see they are already paid for it. And in total, we have 960. It means also we are going to the coming year with an amount of preference interests or preference dividends, which hasn't been settled. So you need to get the accrued. So you'll have the accrued preference dividends or preference interest. So you'll have the accrued preference dividends or interests. You continue down there. Continue down there. Here, you continue here. Continue down there. You have the accrued preference interest. So the whole amount is actually how much? 960 minus what has already been paid, 480. Minus what has already been paid is actually 480. This one here is as per the share balance. And see for it has already been paid. It means what is still having to accrue, which you haven't settled, which is their current liability, it will be an amount of 480. We have accrued preference interest. The interest for the entire year we calculated, we got how much? 960. What has already been paid is 480. What is not yet paid is 480. And therefore that is accrued because it will actually go to the coming financial year. When we haven't paid it will be a current liability. What else? Is one item two people are forgetting. It's normally a free mark. It's another free mark. Sharon has been able to identify it. You just take notes. This is one of the free marks you'll be able to get in a public question. Current tax. And you normally pick what has been proposed. 21,400. You normally pick what has actually done what been proposed. So with all these, you would have already been able to clear up with your statement of financial position. You have already been able to clear up with your statement of financial position. Your statement of financial position. And therefore, this one figure having to remain is the figure for property, plant, and equipment, which now I want us to calculate by considering all the assets in this company. All the assets in this company, what are they giving us as a single figure to go to the property, plant, and equipment. So you can do it now. Now that you've already been able to collect all the other marks very easily. Let's now jumble up our head, confuse our head with this figure for property, plant, and equipment, and see how we could have been able to arrive on that figure. Yeah, so we can look at the property, plant, and equipment computation. So there are three key assets. There are three key assets. We have leasehold. Leasehold what? Leasehold building. Then we have plant and equipment. This is like almost like a PP schedule we are preparing. We have furniture and fittings. Then we'll have the total. Suppose our figures are in fittings. Suppose you can actually be able to start with the costs as per the trio balance. What will be given as the cost of these items as per the trio balance. So for this one is 56 to 50. This one is 55,000. And this other one is 35,000. 35,000. So you can deduct what has already been put as the accumulated depreciation. The accumulated depreciation. The accumulated depreciation. The accumulated depreciation. So your total is how much? So for the leasehold building is actually 18. So you need to deduct. It's already 18. For plant and equipment, because we need some disposals. So let's leave that one first of all. Let's leave that one first of all. Let's consider for furniture and fittings. It is 9,600. So what has already been accumulated as depreciation? Exactly 9,600. Exactly 9,600. 9,600 is already 9,600. 600. 600. And of course, so this one is actually 12. So we can just go to 12,800. 12,800. Yeah, we can just put this one. Is the accumulated on plant and equipment. Then we had some disposals. Disposals of some of these assets. Disposals of some of these assets. We had some disposals of these assets. So you have to dispose them. You dispose them at the net book value. At their net book value. So of course, this asset that was actually disposed, it had a cost of 20 million, but now it is already an accumulated depreciation of an amount of 2.5. And therefore, its net book value at the disposal was an amount of 17,500. It's an amount of 17,500. An amount of 17,500 to be able to dispose it off at its net book value. Because we are no longer having to consider what its depreciation. We are no longer having to consider its what depreciation, which is already included in what? In the accumulated depreciation. Is already included in the accumulated depreciation. So we'll likely be able to dispose it at its net value. Alternatively, you can be able to take this accumulated depreciation here, but now we'll say 12,800 minus what has already been accumulated on the disposed assets is an amount of 2,500. You deduct. That's what you'll be able to place here as a figure. Then you now also dispose it off at cost. You can still dispose it off at cost, which is actually 20. You remove it from this one at 20, which is actually at 20,000. That is at cost. But you have to remember, when you look at the accumulated depreciation of this asset, you have to remove this 2,500 because it is still not part and parcel of this entity because it has been disposed of. This is the accumulated on the asset which was sold. Is already inside this amount. Iko ndani ya hii amount. Unaona hii ndio amount wamekuwa accumulate kama depreciation kwa hizi nini? Plants and equipment. Na ndani yake kuna hii accumulated kwa ile asset wameuza. So it means you have to eliminate it here. You have to eliminate it here from what inside here. So you can do like that. 12,800 minus 2,500. Then you place the remaining accumulated depreciation for the assets which are remaining. You'll be able to get a figure here. But if you do that, you have to remember, you'll have to remove these assets that have actually been disposed, not at net book value, but you'll actually remove it at what? At the cost. You remove it at the cost, which is actually 20,000. Alternatively, consider all the accumulated depreciation. But now when you are removing this asset, remove it at its net book value, which is actually 20,000 minus this amount. You would have done the same thing. You would have done the same thing. And then we can go to eliminate the value here at what the accumulated depreciation. 70,500. So you're able to get the value of that particular asset, the value of that particular asset. Then now we can consider the depreciation for the year. The depreciation for the year. The one you calculated now. This was the accumulated, but now we also calculated for this year. How much has already been lost as what has the depreciation. So for this one is 2250. So you have to deduct. For this one is 6 million. You have to deduct. And for the last one was 1016 or 1116. 1016. So you have to deduct. So when you do that, you'll be able to get the very final figures down here. So how much are you getting for this one? 56,250 minus 18 minus 2250. 56,250 minus 18 minus 2250, which is the depreciation for this year. You'll get a net book value for what is supposed to go to the statement of financial position for this all payments. You are getting 36,000. What about for plant and equipment? What about for plant and equipment? So 55 minus 12,800 minus 17,500 minus 6 million. How much are you getting? How much are you getting? 18,700. Then this one, 35,000 minus 9,600 minus 1016. Minus 1016. Twenty-four three eight four. 24,384, it is correct. Then now you can add 36 plus 87, 18,700 plus 24,384. What are you getting? As the total. Yeah. There's no need of adding this one in any job. Yeah, wasting time. Just add the final figures. What are you getting? This plus this plus this. This plus this plus this. What are you getting? 79,084. So now place that figure under property, plant and equipment. 79,084. Then place that figure under property, plant and equipment where we have left our land. Place it under where we had actually left our land. Place that figure where we had actually left what our land. Then once you've been able to place it there, add the totals for the assets, also the totals for the equity and the liabilities, and give us the final figure. Give us the final figure. I can see actually says 165 to 34. Is it similar to the other side? 165 to 34. $165 to 34. Is it similar to the other side? Yes, I can see. Nashetu says yes. Nashetu says yes. I can see Nashetu. Nashetu says yes. Yeah, so probably people have actually been able to compare that one. They've actually been able to compare that one. So it's the same. And you've already been able to collect a trophy here. You just collected a trophy to Tumeshinda kikombe. Examiner analia machozi. Tumeshinda kikombe. Examiner analia machozi. Analia machozi. Tumeshinda kikombe. So, as we look at an area, it is very rarely tested, but we don't know what this examiner is planning for us. And we don't want this examiner to get us off guard. No way is going to get us off guard. We have to prepare ourselves. And therefore, you can be able to write this branch accounts. Branch accounts. I want to introduce branch accounts. It's a very rarely tested topic, but this examiner should likely end up having to surprise us again. You can write branch accounts. Then I want to introduce, just in a minute, I'm introducing branch accounts. I want to introduce branch accounts. Yeah, so you can write this about branch accounts. Write these branch accounts we introduce very fast. Say a branch is a segment. A branch is a segment. We are together. Faith, are we together? Right? A branch is a segment or part of a business. A branch is a segment or part of a business situated. A branch is a segment or part of a business situated at another part. A branch is a segment or a part of a business situated at another part away from the entity's head office. 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 Then you write, so when you talk about branch, like you know what a branch is. So like what 𝐬𝐞𝐜𝐻, they have almost like 60 branches. But of course they have what a head office, where they actually do their central operations, central coordination exactly operations about as to how the business is exactly supposed to be carrying out its operations. So there are different types of branches, right? Types of branches. Types of branches. Types of branches, then you write this. Types of branches, then write this. Dependent branches. Right, this dependent branches, right? It is a small branch whose main activity, dependent branches, it is a small branch whose main activity is to sell goods. It is a small branch whose main activity is to sell goods supplied by the head office. It is a small branch whose main activity is to sell goods supplied by the head office. Supplied by the head office. By the head office, full stop. Then another paragraph under that, right? They do not maintain accounting records. They do not maintain accounting records. They do not maintain accounting records, but they usually depend on, they do not maintain accounting records, but they usually depend on the head office. They usually depend on the head office. They usually depend on the head office for the accounting function. They usually depend on the head office for the accounting function. They usually depend on the head office for the accounting function. They usually depend on the head office for the accounting function. Then you write type number 2, independent branches. Independent. So this one depends on the head office. So they don't actually maintain their own books of accounts, but their books of accounts will actually be maintained by the head office. For them, they just supply the goods, then they actually sell. But all the accounting records are actually what are the head office. So then you have independent branches. Independent branches. Independent branches. Independent branches. You write this about independent branches. They are branches which operate as a separate business. They are branches which operate as a separate business from the head office. They are branches which operate as a separate business from the head office. They are branches which operate as separate business from the head office. They are branches which operate as separate business from the head office. They are branches which operate as separate business from the head office. Another paragraph. Another paragraph. They maintain their own set of accounts. they maintain their own set of accounts. They maintain their own set of accounts. And in addition, they maintain their own set of accounts. And in addition, to the goods supplied by the head office, and in addition to the goods supplied by the head office, they have authority to purchase. They have authority to purchase their own goods. They have authority to purchase their own goods. They have authority to purchase their own goods. Their own goods. Then number 3, another type of branches, we call them foreign branches. Foreign branches. We call them foreign branches. We call them foreign branches. Foreign branches. Then right, these are branches located. These are branches located in a foreign country. These are branches located in a foreign country. In a foreign country. These are branches located in a foreign country. Full stop. They can either maintain their own accounting records. They can either maintain their own accounting records, or they can be maintained by the head office. They can either maintain their own accounting records, or they can be maintained by the head office, or they can be maintained by the head office, or they can be maintained by the head office. So those are the types of branches we can be able to have. So independent, we can have foreign branches. When you write another small heading, write ledger accounts maintained. Ledger accounts maintained. Ledger accounts maintained. The ledger accounts maintained. Ledger accounts maintained. Just like ledger accounts maintained. Ledger account maintained. There has to be part 1, right? Number 1. The ledger accounts maintained. Number 1. Right branch inventory accounts. This one is normally maintained at the invoice price. So we'll see what is the invoice price later on. So we just want to maintain at the invoice price. Goods sent to the branch account. That's number 2. Goods sent to branch account. That's number 2. This one is usually at the costs. At cost of the goods. At cost. Just say at cost. Now we get the difference between the two, the selling price and the cost price. Now account accounting according to the branch markup accounts. Only the branch. Markup account. So how do we get the branch markup? So you simply get the invoice price minus what they cost. So we get the selling price minus the cost. Is maintained at selling price minus. Since the difference between the two values in place them in a branch markup account. Like a profit account. So separate profit account. Then you have the branch debtors account. Branch debtors account. Then account number 5, which is very key on the branch expenses accounts. As one, the income statement for the branch. branch income statement. Branch income statement, the branch income statement. It is the branch income statement. Branch letters. The branch letters. Letters accounts. Branch letters accounts. Branch income statements. Branch income statements. So these are the data accounts that will be maintained. So we can end there. You can just be able to write a small heading, or you'll be able to pick up from tomorrow. So the key journal entries. Journal entries. The key journal entries. Be able to pick up from there. The key journal entries that you'll be able to pass when you are preparing branch accounts. Right, the key journal entries. So look at the key journal entries, then you can look at an illustration on branch accounts. Otherwise, we can end there. It's end there for now. See you tomorrow. See you tomorrow as we continue the revision. Any question? Any question before we end? Any question before we end? Any question before we end? Seems there isn't. Seems there isn't, so you can have a good night. So enjoy your Easter. So that enjoy your Easter.